thank you all for being here. Thank you to the 3 territorial governments and the federal government and to the PDAC. It's a pleasure to be here. It's an honor to be here and to speak. Anne asked me to talk about critical minerals and minerals critical to the Canada's north. And in doing that, I pulled together perhaps the beginning of a large book, which I tried to distill into a 30-minute presentation today. And I wish I had brought a Canadian maple leaf with me to offer it to anybody who can, at the end of my presentation, say, oh, this is what Jeff meant. Because I think that I've got probably 3 distinct trends that I want to talk about, and they somewhat conflict with each other. We're looking at critical minerals and a tremendous change. Let me see what I can do here. That doesn't do it. That does it. Talking about critical minerals at a time of tremendous change in the global economy and society and political system. And we're moving on an energy transition that it has a great deal of uncertainty attached to it. We're transitioning to something that we think we know what it is going to be, but there'll be all kinds of changes in the map on the way from where we are today to where we're going to be in 2050 and in 2100. This, as of now, 2022, is a list of what the Canadian government says are critical minerals. Other countries have had critical mineral lists for long times, and what we've seen is a shift of metals in and out of those lists. We would expect things to metals to be added to this list and metals to come off of this list. Titanium is not on it now, and we think it'll continue to be for a variety of reasons. If you go back 40 years ago to 1981, 1982, there was a whole push for what was called strategic metals, which are somewhat different. I'll talk about it in a second, from critical minerals. And what we found was that certain metals, for example, you now have platinum group metals on here. I'm not quite sure if that's all 6 platinum group metals or if it's some particular metals. The United States government had PGMs as critical and strategic metals from the 1940s into the 1970s or 60s, but then it took them off. It had silver as a critical and strategic metal during that period of time, but in the 1960s, it took that off. So this will change as the technologies that we invent and develop change too. But this is the list right now. It's quite extensive. And what does the Canadian government define as critical metals? Essential to Canada's economic security, which is an issue that some people have worried about for a long time, but has now come to the fore over the last several years. Required for Canada's transition to a low-carbon economy, and a sustainable source of critical minerals for the partners of Canada as well as for Canada. And I know that my government, which I don't represent, has said certain things about, oh, well, you know, when we look at U.S. critical minerals, we include Canada's resources in what's available to us, which is a little bit hubristic. So there's critical minerals and metals, and as I said, you know, and most people define them that way. They're essential to economic activity and therefore economic and national security, not only for Canada, but for other countries. And we have seen, I've been doing this since 1975, we've seen an ebb and flow of government and social concerns about the availability of critical minerals. And we went through a long period of ebb, and now we're flowing back into it. Strategic minerals and metals are a little bit different in that they're necessary for technological and industrial processes. And they are in short supply, and they usually come from a handful of sources: cobalt from the Congo, platinum group metals from South Africa and Russia, for example, and they don't have known alternatives, rare earths, in some applications. And rare earths, I think, are somewhat at risk for finding alternatives. But you can find, for example, platinum group metals. In the 1970s and 80s, they were strategic and critical metals because they came from South Africa, which had massive political problems that it had yet to resolve. And it had political unrest and a very divided society. It still does. And Russia, the Soviet Union. So these were very critical. But even in that environment, you start to see, as I said earlier, the U.S. government saying, well, platinum group metals maybe aren't that strategic. And we had strategic reserves of platinum and palladium and I think just platinum and palladium at the time. And they said, we can sell those off. But then they added iridium because they needed metal. And in the late 70s, in the early 80s, I was working for a company that actually traded with the Soviet government a lot. And the Soviets started buying iridium from us. And we said, okay, you don't refine it yourself? They said, no, we don't. And they said, well, why are you buying it? And they said, well, because the U.S. Defense Department has added iridium to its list of strategic metals, so you must have a use for it. And if you have a use for it, we will soon. So it's interesting. Now, gold and silver. I do want to talk about them, and they are important. They're not critical. They're not strategic. They are not of short supply. There are gold and silver reserves and resources to be mined around the world. There are 16 billion ounces of silver reserves that are mineable and larger resources, equally large amounts of gold, and there are ample above ground refined inventories. However, gold is very critical. It's financially important. It's not part of, people ask me sometimes about the monetary role of gold. And I say, well, monetary role of gold basically is as a monetary reserve asset, and the use of gold as backing for currencies really went away in 1971, is probably never going to come back for a variety of reasons, which I won't bore you with. But financially, gold is very important. And the difference between monetary is, that's central bank and monetary policy, and financial is private industry and people as a form of investment, as a form of savings, and as a quasi-money. And gold is very important and has become ever more important over the last 2 decades. We gave a speech in 2020 and wrote reports about it, saying that we would see a renaissance in the financial role of gold, that investors around the world would start coming back to gold, not as a replacement for other financial assets, but as a supplement. And in the period from 2002 to 2022, we have seen more investors buy more gold for a longer period of time at higher prices in more parts of the world than ever before. Anglo-American estimated that there were about 350 million ounces of gold held by private entities and investors in 1966, when the gold-dollar relationship was starting to end. And in the 20 years since 2002, investors have bought probably twice as much. So gold is very important. It's a financial asset. It's not a critical metal, or it's a strategic metal. And the Northern Territories all have it, I'm glad to say. And we've been glad to say that we've been involved with various people working with diamonds as well as gold and silver up there. Silver is no longer considered a critical or strategic metal. There are ample reserves in the ground. There are 5.5 billion ounces of refined silver in bullion and coin form held by investors around the world. But it's very important. And it's important partly as a financial asset, and it's also very important for the energy transition. It is central to solar power. Silver is used in solar panels, and it is the presence of silver in those solar panels that have made them cost competitive. I'll show you a slide later. I wrote a book on electric vehicles in 1979, and when I completed it, the publisher wanted me to write a book on solar power, 1979, 1980. And I actually initially said yes, and then I said no, because the solar panels simply were not cost effective then. Neither were electric vehicles, but I got paid for that book. 40 years later, they are. And it's very critical. And, you know, I have solar panels on my house in New York. In 1980, people said you can't have solar power in New York. You now have solar power all the way up to the territories. And it's silver's use in those panels that has made that possible. Silver EV requirements are important. They're being overstated in the market right now. Our estimate is that current petroleum-powered vehicles use about 1 ounce of silver per car. Current EVs and expected EVs use about 1.5 to 2 ounces of silver per car. That's a lot. I mean, it's 40 million ounces of silver, 50 million ounces of silver now in petroleum-powered cars. And if you double that, that's going to be another 50 million ounces of silver being used in vehicles as electric vehicles take market share. So it's a significant use, but it's not the 6 or 7 or 10 times that you'll hear in the silver market. So there is a lot of hype there going on. There are ample above ground inventories and everything, as I said. Now, what I'm going to do, I'm not sure what slide I'm on here. I'm going to talk about my conclusions after this slide. These are, unfortunately, 2020 figures of minerals output, critical minerals output in the territories. And you can see, you know, the role of Northwest Territories. Had a bad year in 2020, we all did. Interestingly, Nunavut actually had a very good year in 2020 simply because you had some major new mines coming on, and the Yukon had some bumps, but it's coming better. But what I want to do right now is I want to talk about my conclusions because I'm going to run out of time. These are the metals that we see as being critical to Canada's north right now. And by that, what I've said is these are minerals that we, or others, that we collectively as a people know are present in the territories and are mineable in the territories and can be developed. Other metals on that critical metal list probably exist there, but as earlier people said, there hasn't really been a lot of exploration yet. There has been a lot of exploration, but there's a lot more to do simply because of the enormous size of the territories. So this is sort of the list of critical minerals right now that are important to Canada's north, but as with the total list, it'll change. But I want to talk a little bit about my conclusions because I think one of the big issues is where the money will come from. Then I will go back into the industries using it, and that's where I get into this muddy water of, we're not negative on electric vehicles. We like to think of ourselves as realists. We think there's a lot of headwinds in the energy transition that will cause the energy transition to be bumpier and slower than a lot of people think and a lot of people would like. The IEA, I'll show you some slides in a second, has different scenarios. And they have one scenario, which is that a lot of people look at, which is, let's assume that all of the governments live up to their promises of the Paris Accord. Okay, they haven't for the last 10 years, but that's beside the point. And they use that, and they have very optimistic growth in electric vehicles and other energy technologies. Then they have one called the STEPS scenario, which is, let's look at how things are going now and say, okay, governments are not going to improve their performance in meeting the Paris Accords over the next 30 years, and this is what it looks like. We use that one, and I'll show you some slides there. But one of the things that we find is, where's the electricity going to come from? There's not enough electricity for now. I mean, around the world, definitely in the United States, you're having blackouts, brownouts, and all kinds of collapses of the systems. So there's not enough electricity yet. Second thing is the source of energy, which I'll show you in a second. Third thing is the grids are not stable enough to provide current energy needs, let alone what we would need for power. There are some issues in electric vehicles that could come back and bite proponents of electric vehicles on a consumer level. First off, with electric vehicles, you're not necessarily reducing carbon dioxide emissions as much as people think. You're simply shifting where they're being generated from the car to where the electricity is being generated. And another one is, in the United States at least, and many jurisdictions, if you buy an electric car, the utility will give you a lower kilowatt per hour rate for buying your electricity. And in the small print, it says, oh, by the way, we have the right as a utility, if we need the electricity, to come into your house and drain the batteries in your car. So if you're sitting in Texas in early 2021 and your power goes out and you have no heat and you have no power, and you say, well, let's jump in the car and drive to Arizona and stay with my brother because he has electricity. You go out to the garage and the car's been drained of electricity. That could really put a damper on consumer enthusiasm for electric vehicles. And the third one, which maybe relates more to what I do for a living, is where will the money come from? There's an enormous constraint in money that needed for mining, first for exploration. Why is this not moving? There's an enormous constraint for money needed for exploration, for mining development, for mining operations, and then for processing those raw materials into components and motors and other parts. And I'll get back to that. But addressing the capital constraints just for mining and exploration, we've done some work for the PDAC, a couple studies over the last couple times, a few years prior to the pandemic, on capital formation in the mining industry. And one of the things that we found, and we've seen this in our other business as well as the studies, is there were 6 sets of reasons institutional investors have been moving away from, and they're not as actively investing in exploration and mining companies as they were in the past. And when you say, well, why is that? And you look at and you talk to the institutional investors, you find that there was like 6 big sets of factors, and 5 of them had nothing to do with mining, and they had to do with changes in the institutional investment industry. They are under cost pressures too, believe it or not. Their investors have been very much upset with their performances. They have been overinvested in low interest rate bonds, so that if you're working with pension funds, which are supposed to match their returns with their future payouts, these guys are underwater and they have no idea how they're going to generate the kinds of profits they need to in order to meet future pension requirements. So there's a lot of pressures on the institutional investment industry, and those are on the buy side, and then the sell side is suffering because the buy side is suffering, and they're saying we have to lower our costs, and by the way, why are we paying you trading fees when our traders now go on electronically and process the trades? It's not like we're calling you up and placing orders for trades anymore. So there are 5 sets of factors that are causing that industry to say, we're not going to invest in companies, we're not going to invest in smaller companies, we're not going to invest in individual companies, we're going to invest in indexed funds and ETFs, and we're going to let machines run that because they're doing better than the people managing those funds looking at companies. So there is a drying up of institutional funds for small business. And there's a break in what the stock market does for the economy. The stock markets were created for capital formation purposes. People would buy stock in companies, and those companies would use those proceeds to build their companies. And there is now a break between capital formation for businesses and investing in the stock market. And it's been coming for 160 years. There was a very wise economist in the 1880s who said this is what's going to happen. You're going to have capital divorce itself from labor. And that's one of the factors that's been happening. It's kind of been masked by the economic lockdown and recession, but it's there. Only one of the sets of factors had to do with mining exploration, and that was institutional investor dissatisfaction with the performance of mining companies. I'll give you one example of a sovereign wealth fund that we work with. 10 years ago, they had no investments in mining. They invested in a gold mine, a couple $100 million. They looked at it as one of the world's largest sovereign wealth funds. They looked at the mining industry and they said, we should deploy at least 2 or 3% of our assets in mining, which means $5 billion of investment in the mining industry. The lockdown came, these changes came that I was talking about on the investment side, and they have decided to get rid of that gold mine and to go to zero exposure to mining. That's the capital constraints that we're facing as a mining industry. Now, historically, the good news is that exploration and mining has been mostly financed by wealthy investors, family offices, or whatever they were called 100 years ago, individual investors, and smaller institutions. And those entities and people are still very much interested in mining. And the mining industry needs to refocus and say, those are the people that we should be targeting for investing in our companies. And they need to do that again. You have any number of mining companies who long for the largest fund management companies in the world to invest in their mining companies. But of the top 25 asset management companies in the world, none of them can deploy 2% of their assets, which is considered to be a significant amount. None of them can deploy enough money in the mining industry to do it. The market cap of the gold mining industry is such that none of the top 25 asset managers can say, oh, well, I can buy every share of a gold mine listed in the world and not reach 2%. So stop marketing to them. Start marketing to people who appreciate small, profitable, well-run companies. That's really the key. Now, one of the things that we're doing is we have started talking about creating a Yukon mining exploration fund to develop and invest in exploration companies and development companies and early stage mining companies. It would provide capital and would also provide management advisory services. So we would we would be an activist investor, this fund would be an activist investor. And we have lined up 2 people that we have served as clients of ours, one since the 1990s at various asset management companies, who has done very well investing in the mining industry, partly because he took our advice. And the other one was our client starting around 2000 or 2001. And they both are ready to work with us on the Yukon Mining Exploration Fund. We also are talking to marketing people, and we brought in marketing people. My colleague Sam Carey is here today that have experience in marketing mining investments to investors, high net worth individuals, et cetera. And we have a stable of investors that we know. We would also diversify the risks. An investor today says, I'm interested in Nunavut, Northwest Territories, Yukon, and I could invest in any one of these 10, 20, 40 companies. Let me say that I have $10 million I could put into a company. I have taken a very high risk. But if I put that money into a fund that other people are funding, and that fund invests in 10 or 20 or 40 companies, I have diversified my risks. I have a greater chance of profits. I have a greater chance that some of those companies will actually turn profits and generate revenue for me, and the share prices will go up. So it's a way of diversifying the risks for the investors. It also diversifies the risks for the mining companies, because all of a sudden you don't have a large investor someplace in the world who has can jump on the springboard and you fall in the pool, whether or not the water's in there. And then a sidebar is that we would include investments in First Nation corporations that would provide services, support services, camps, core shacks, diesel fuel delivery to exploration and development companies. So we're looking and we're actively saying, okay, we see the need for capital, we see the capital constraints, and this is one way to try to reduce the risks that are causing those capital constraints. So we're very interested in working in the territories with the territorial entities. And there are a number of other really cute bells and whistles that we have in that one too. Now, that's my presentation. I think I have 5-10 minutes, and now I have about 2/3 of my presentation. I'll run through this relatively quickly, more on this. The future of motive power is a hierarchy of uncertainties. What will the future motive power be? We're not going to know really for 30 years. And it may change. Electric vehicles are winning now, and they may continue to win for the next 10, 20 years. And then they may not. They may be replaced by hydrogen engines. If it's electric vehicles, which battery technology? And one of the things that we're seeing just in the last 12 to 24 months is you add manganese to lithium iron phosphate batteries, and you change the power density to the point where they now compete with what they call NMC batteries, which are the lithium ion batteries that use nickel, manganese, and cobalt. They can now compete with them for motive transportation. If it's lithium, which technology is going to be used? There are all of these things, and then there's a lot of hype in the market. Let me see. These are my first 2 slides from the IEA. These are the International Energy Agency. This is an independent organization. This is where they think energy is coming from for humanity over the next period to 2040. It's 2019, 2020, 2030, 2040. Oil, they expect to be the major source of power and energy in 2040. And that we will be using more oil than we do today. Natural gas rising sharply, number 2. Coal falling, but still a big one. All renewables together, a distant 4th. Now, they have taken it to 2050, and between 2040 and 2050, combined renewables supplant coal. And coal falls down, and you can see in 2050, the IEA, this is the steps projection. This is like the realistic projection, as opposed to let's assume that governments get their houses in order and do what they said they need to do. Coal has fallen back to levels similar to 2010. Oil has risen. Natural gas is rising, and renewables are rising. That's very important to understand. We still need all these critical metals for electric vehicles and for the energy transition. But 30 years from now, we're still going to be using platinum, palladium, and rhodium to clean the exhaust from petroleum and natural gas combustion. So you see in the platinum industry for 10 years, underinvestment, in part because, hey, no one's going to be using PGMs because we're all going to electric vehicles. Yeah, no, we're going to be using PGMs for a long time, long after I'm gone. These are some of the penetration rates that you'll see in the market, and this is a couple years old. This is a year old. This is from last year. These are some of the penetration rates to 2030 for electric vehicles. The optimists were saying, yeah, we might be at 33% by the end of this decade. Other people were saying, no, it's going to be 7%, 10%, 12%, 25%, 23%. There's a great deal of uncertainty as to what it's going to be. These are the projections we use to 2050. The dark blue part is gasoline-powered vehicles, and the light blue part are battery electric vehicles. We have them growing. We have them growing tremendously over the next 30 years. And by the year 2050, half of the vehicles will still be burning petroleum products. And there's more. Oh, wait a second, I think I skipped one. So you have the energy transition. It is happening, but it will be delayed. The big 3 I've talked about: electricity generation, stable grids, and the lack of metals, minerals, and motors and controllers. And that is being compounded by, as I say at the bottom, the uncertainty over which technologies will be there. Okay, let me invest in cobalt mines. 5, 10 years ago, people were pouring money into cobalt exploration and development companies, most of which were there, because they thought that we'd be using 30% cobalt sulfate in lithium-ion batteries. And then the battery manufacturers said, no, we need 20%. We're going from 70% nickel sulfate, 60%, there's 631, 60% nickel sulfate, 30% cobalt sulfate, 10% manganese sulfate. Then they went to 622. 60% nickel, 20% cobalt, 20% manganese. You cut your cobalt expected future cobalt needs by 33%. Then they went to 811. Now you're using 10% cobalt and you're using 67% less cobalt than you thought you would. So bad investments in cobalt. Manganese, however, went from 1% to 30%. So you were using a lot more manganese. And then, as I said earlier, we have seen some developments with lithium iron phosphate batteries where they're adding manganese. So manganese seems to be a winner now, and cobalt seems to be a loser. But those are uncertainties, not just in metals and mining, but in motors. I need these motors, and I need these high-efficiency motors using these rare earth minerals. Well, you know what? I can't find the rare earth minerals. So I'm going to use a different motor. So all of a sudden, people investing in rare earth mines and factories to build rare earth magnets and factories to build motors containing rare earth metal magnets have misallocated their capital. That's slowing it down. And then there are these consumer backlash issues I talked about. So there are all kinds of limitations, including time. I think I'm out of time. So you'll see this. You'll get this presentation from at least the Yukon Mineral Alliance will have it. So I'll run through it. The big winner right now looks to be nickel. The second biggest winner looks to be manganese, and other metals are lagging. But here's the other one, yawning persistent shortfalls. You listen to people say, oh, we're going to be having 35% of the vehicles being electric vehicles by 2030. Okay, where are you going to get the lithium? Where are you going to get the nickel, high purity nickel sulfate, the high purity manganese sulfate, the high purity cobalt sulfate? You have these yawning persistent shortfalls. And you talk to the policymakers and they say, well, people will develop those mines. Yeah, right. It takes a year to build a motor factory, 2 years to build an electric vehicle factory, and 10 to 20 years to find and develop a mine if you can get everybody to allow you to do it. So there's a big there. Okay, and this is, I just have to throw this in. In 1978, I wrote a newsletter on electric vehicles. In 1979, I wrote a book on them. And, the gist of the book was these things are decades away from commercialization. So I'm going to go get involved in metals research. But we've seen it all. That's us. I think, do we have time for some questions? Yeah, we can. And it can, if any, look, I made the joke at the beginning. This is a complicated, broken field. And it's not going to be an easy transition. It will be a transition. But if anybody can tell me how that transition is going to accurately move forward over the next 10, 20, 30, 40 years, let me know. Because I don't see a clear path. I think there's going to be a lot of changes and directions over the next several decades. It's not going to be a decade, it's going to be decades. Questions? I guess my work is done here. Oh, yeah. Yes. I think they want you to speak into the microphone because it's being recorded.
The overall critical minerals, especially the EV revolution and then green metals, the Canada North is the best place to explore and then develop, in your opinion, or anywhere in the world?
It's interesting because people say, why are you looking at a Yukon mining exploration fund? Yukon and the other Canadian territories, northern territories, have tremendous mineral resources. What we've seen, what has been explored and discovered has been tremendous. And we know that we're just literally scratching the surface there. So it's a very highly prospective place. We know deposits that were discovered 40, 50, 60 years ago that really are worthy of development, but they haven't moved forward. But you also have a jurisdiction where the legal and regulatory environment is much more positive, and the social environment and political culture is much more positive for mining than in other parts of the world. So I'm not sure that I would say that the Northern Territories are the best place, but they are definitely one of the best places to explore and develop mining right now.
Yes, just to follow, given that, but if you develop in the Canada North, the disadvantage is that you have only 3 months summer at most, and then it costs more to back and forth people. Airplane, you have to charter, you have to stay. So that cost disadvantages, do you think is still relevant for any investors or any miners to go there?
It absolutely does, and that's probably one of the reasons why it's been explored and underdeveloped. One of the earlier speakers was talking about the fact that mounting exploration efforts in the territories is 2 to 3 times more expensive than it is in the lower provinces. So that is definitely an issue that is a limitation, but it's a limitation that is an order of magnitude smaller than the potential discovery rates difference. All right? Any other questions? Oh.
Thank you. With the still increasing usage of oil for the next couple of decades or so, and the focus here on critical minerals and knowing that there is potential to get critical minerals out of oil production as byproducts, is this an opportunity you would possibly consider to invest in, both financially and technology-wise? And if so, does it mainly or only apply to the southern provinces, or potentially is this also an avenue for the north to develop these resources?
I think the recovery of heavy metals from oil sludges would not provide significant volumes of the kinds of metals that you need and want. So I think it's relatively small type of thing. And you'll tell me when I need to, you'll pull. I'm good? Thank you very much.